Welcome back to the channel. Today we're diving deep into MongoDB's Q1 2026 earnings report. This is a crucial quarter for the company, reflecting its growth in the cloud sector and its strategic investments for the future. Before we analyze the data, please take a moment to like this video and subscribe to our channel. Your support helps us provide high-quality financial insights. Now, let's get started with the analysis. Starting with revenue, MongoDB has demonstrated impressive growth trajectories. The total revenue for the quarter reached nearly $700 million. This represents a 26.7% year-over-year increase. This growth is primarily driven by the strong adoption of MongoDB Atlas, their cloud database as a service offering. As we look at the historical data from Q2 2016 to Q4 2025, the upward trend is consistent and accelerating. The company's ability to maintain high double-digit growth even as it scales is a testament to the strong demand for modern developer-focused databases. In the last year alone, revenue grew by over 26%, and the 5-year compounded annual growth rate stands at an impressive 32.4%. This consistent performance indicates a strong market position and successful execution of their go-to-market strategy. We expect this momentum to continue. More enterprises migrate their workloads to the cloud and modernize their data infrastructure, driving long-term sustainability for MongoDB's core platform. The future looks bright for the cloud segment, as MongoDB continues to capture a larger share of the overall database market worldwide. Moving on to expenses, MongoDB continues to invest heavily to fuel its growth and market share gains across global territories. Total operating expenses reached approximately $500 million this quarter, categorized across several key areas including research and sales development. Sales and marketing remain the largest component of their spending, reflecting the competitive nature of the enterprise database market today. However, we see that research and development spending also grew significantly at 25.7% year-over-year, prioritizing core product innovations. This highlights MongoDB's commitment to maintaining its technological edge and product innovation in an increasingly crowded and AI-focused data landscape. General and administrative expenses also rose by 26%, indicating the growth in operational complexity as they scale globally and expand operations. Over the last 5 years, the CAGR for sales and marketing expenses has been 20.5%, which is notably slower than their revenue growth. This indicates some level of operating leverage as the company becomes more efficient in its customer acquisition efforts and cloud platform expansion. Turning our attention to EBITDA, MongoDB's performance shows significant improvement over time. For Q1 2026, EBITDA reached positive levels. This is a major milestone compared to historical losses. Looking at the chart from Q2 2016, we see a long period of negative EBITDA. The company prioritized growth over short-term profitability for years. This trend began to reverse significantly starting in 2023. The year-over-year improvement in EBITDA is over 119%, indicating a strong move toward operational efficiency. This positive trajectory suggests that the company's business model is scaling effectively, with revenue growth finally outpacing operating expenses. Management's focus on cost discipline while maintaining high revenue growth is clearly paying off in these most recent quarters. This shift to positive EBITDA is a critical signal for investors looking for long-term sustainability in the database market. It demonstrates that the core database platform is becoming highly profitable as it matures in the enterprise market globally. Next, let's examine net income, which follows a similar trajectory to EBITDA but includes all remaining costs and adjustments. While net income has historically been negative due to high stock-based compensation and growth investments, we are seeing narrowing losses. In the most recent quarters, net income has approached break-even levels on a non-GAAP basis, which is a significant development. The chart shows the deep investment phase between 2020 and 2022, where net losses peaked during the global Atlas expansion. However, the trend since 2023 has been one of steady and consistent improvement across all financial reporting metrics. The one-year change shows a stabilizing net income, even as revenue expands rapidly across different regions and customer segments. This suggests that the company is reaching a critical inflection point in its financial maturity and overall business scale. For long-term investors, this narrowing loss is a key indicator of the company's clear path towards sustained GAAP profitability. Earnings per share, or EPS, provides another layer of insight into MongoDB's financial health on a per-share basis for investors. The EPS chart shows the historical loss per share, which was particularly deep in the early stages of their cloud transition. We see significant volatility in EPS from 2016 through 2021 as the company invested aggressively in its global infrastructure. However, much like our other metrics, the EPS gap has been narrowing consistently in the most recent fiscal years and quarters. The improvement in EPS is happening even as the total share count increases, reflecting the underlying strength of the net income trend. Analysts often focus on non-GAAP EPS, which removes one-time costs and stock-based compensation to show core operational performance. The market consensus for MongoDB's EPS has been trending upward as the company consistently beats expectations in its quarterly reports. Looking ahead, the path to positive GAAP EPS is becoming clearer, providing a strong foundation for future valuation and stock performance. Free cash flow is perhaps the most critical metric for a high-growth software company like MongoDB, as it represents actual cash. MongoDB has successfully transitioned into a consistent generator of positive free cash flow, as seen in the recent quarterly data. The most recent quarter showed a dramatic surge in free cash flow, reaching nearly $180 million, an all-time high for them. Looking back at 2017 and 2018, the company was consistently cash flow negative as it built out its global cloud platform. The chart highlights the one-year change of over 631%, which is an extraordinary acceleration in cash generation efficiency. This reflects an efficient cash conversion cycle and the high-margin nature of the Atlas Cloud platform as it reaches maturity. Strong free cash flow allows MongoDB to fund its own operations and future R&D without needing to raise additional external capital. This self-sustaining growth model is a key differentiator for MongoDB in the current economic environment and competitive technology landscape. Now, let's examine return of capital. Historically, MongoDB has not returned significant capital to shareholders as it focused on growth. However, we've seen some recent activity in late 2025, which marks a potential shift in management strategy as the business matures. As the company continues to generate significant free cash flow, investors are watching for future buybacks or even the possibility of dividends. Effective capital allocation remains a top priority for the board of directors as they balance growth investments with shareholder returns. The spikes shown in late 2025 reflect tactical decisions to manage share dilution from stock-based compensation programs. In the broader software sector, returning capital is a sign of financial strength and confidence in future cash flow sustainability. While still early, this development suggests that MongoDB is entering a new phase of its life cycle as a large-cap technology leader. Management's commitment to creating long-term shareholder value is evidenced by this disciplined approach to capital management and returns. The balance sheet remains one of MongoDB's greatest strengths. As of the current report, the company holds a massive cash reserve. Looking at the green bars, we see cash and short-term investments reaching nearly $2.4 billion, providing immense financial flexibility. While the red bars show total debt has increased to $23 billion, the majority of this is related to long-term lease obligations. The net cash position is healthy, allowing the company to navigate any potential economic downturns while continuing to invest in Atlas. Historically, the company has maintained a very conservative liquidity profile, ensuring they are never forced into unfavorable financing rounds. This large cash pile also generates significant interest income in the current high-rate environment, further boosting their non-GAAP net income. Financial strength also provides a war chest for potential strategic acquisitions to expand their data platform into new adjacent markets. Overall, the balance sheet provides a solid foundation for MongoDB to execute its vision for the next decade of database innovation. Finally, let's look at the valuation summary. MongoDB currently holds a market capitalization of approximately $20.5 billion. The price-to-sales ratio stands at 835, which is typical for a high-growth SaaS leader with strong competitive moats and recurring revenue. While GAAP profit margins are still slightly negative at 2.89%, the trajectory suggests a clear path to positive margins soon. Quarterly revenue growth of nearly 27% confirms that the company is still in a high-growth phase despite its multi-billion-dollar scale. Operating margins are also improving, reflecting the benefits of scale and the high-margin nature of the Atlas Cloud service. The market continues to reward MongoDB with a premium valuation due to its dominant position in the document database category globally. The balance sheet net of $2.36 billion provides a safety net that is well regarded by institutional investors and credit analysts. In conclusion, the valuation reflects a high-quality asset with strong fundamentals and a massive runway for continued expansion in the cloud. That concludes our deep dive into the MongoDB Q1 2026 earnings report. The data shows a company that is successfully scaling revenue. Thank you for watching. If you found this analysis helpful, please share it and stay tuned for more financial insights. See you next time.